Hi, Ken Boyd, Accounting Accidentally. This video is called Close Elections and S&P 500 Index Gains. And authors note that my fifth book, How to Manage Personal Finances, will be out in early 2025. You can find all the chapters explained here at accountingaccidentally at substack.com, and you can also email me at ken@stltest.net for the book's publishing date. I'm recording this in late August of 2024, and we're on the verge of a presidential election. We live in a 50-50 split country. It's very close. In fact, it's so close that, as USA Today reports, there are 15 counties, not just states, but individual counties within states that are the key to winning the 2024 presidential election. So incredibly close, just a few counties are going to make the difference for the whole country. So why do I bring up the election, the close election? Well, it's similar to what can happen in an index fund, and many of us use index funds for investing. And it is the case that often just a small set of stocks can make up most of the gain or most of the losses in your index fund. So let's talk about one of the stock indices, the NASDAQ 100. NASDAQ is one of the exchanges, and this is a basket of, as it says here, 101 equity securities issued by 100 of the largest non-financial companies listed on the NASDAQ exchange. It is a modified capitalization weighted index. That's a mouthful that I'll explain later. So what does it have in it? This index includes stocks from a variety of industries, including industrial, tech, retail, etc. This was taken from something I wrote in 2023, and it says CNBC reported that as of 7/20/2023, the index had a 37% year-to-date return, a huge return when we're only a little more than halfway through the year. Well, that seems great. But there's a catch. The three biggest names in the index accounted for more than 30% of the index gains. And at the moment, that is when I wrote it in 7/23, Microsoft made up 12.7% almost of the index, and Apple was over 12% of the index also. So two stocks representing about 25% of the entire value in the index. How did it happen? The big tech stocks generate huge revenue and profits. More investors buy the stock, and the total market capitalization, which is number of shares times outstanding shares times share price, number of shares outstanding times share price becomes massive. It grows and grows and grows. And the problem is these high performers become a bigger percentage of the index just by their success. So what does the index do? It does something called rebalancing. So NASDAQ rebalanced the index, provide more diversification. People buy these index funds for diversification purposes. Why do they do it? They want to avoid a situation where the individual weights above 4.5%, that is, individual stocks that make up 4.5% or more, are more than 48% of the total index. That is their methodology for staying diversified. Why did they have this rule? Well, there's regulatory rules about diversification with registered investment companies. So in order to have this product presented to investors as a diversified vehicle, you've got to maintain the diversity. How do you do it? You do it by rebalancing. So what do they do? Last bullet, NASDAQ adds up the value of the stocks that make up 4.5% or more. And if that total group of stocks is more than 48% of the index, you have to rebalance, meaning that you sell some of the big holdings and diversify into other stocks. What all this means to investors is if you invest in a vehicle that uses an index fund, talk to your investment advisor about the percentage of the large holdings and how much of the total fund they make up. And number two, make sure you understand how often it rebalances so that you truly own a diversified investment.